a loss of 2.5 billion in 4 months. It will break even by the end of the year. How did George Soros get defeated in the technology foam in 2000 and then turn the tables? Did Soros create the technology foam, or did the technology foam defeat Soros? What insights does this trading case of George Soros provide for our investment? Hi, my friends. Welcome to ZC's Finance channel. This is the 6th episode of ZC's 5-minute financial series. Today, we're not just talking about a trade. We're unpacking a masterclass in fixing mistakes from George Soros. His 2000 tech bubble play. Most people remember his wins against the pound or baht, but this one, it started with a disaster. His quantum fund lost 22%, over 2.5 billion in 2000 alone. But here's the kicker. By December, he'd clawed back 40% of that loss, all by shorting the collapsing Nasdaq. How did he turn a career worst quarter into a lesson in resilience? Let's go step by step with the exact data and decisions most analyses skip. First, let's set the scene. Late 1999, the U.S. tech bubble wasn't just a trend, it was a mania. The Nasdaq Composite had jumped 86% that year. But here's the catch. 70% of .com stocks had no profits, 40% had no revenue. Investors weren't buying companies, they were buying the word .com. A startup called eToys went public at 28, share and hit 84 on day one, even though it lost 190 million in 1999. Soros' right-hand man, Stanley Druckenmiller, later told biographers, "We sat in meetings saying, this is a bubble, but then we'd see a stock double in a week and think, what if we miss more?" That's how FOMO breaks even the best. Phase 1. The costly mistake. Chasing the bubble. Late 1999 March 2000. Soros fund didn't just dip a toe in, they jumped in with leverage. Here's the play-by-play. 1. The long position built of 1999 Jan 2000. Quantum fund allocated 10.7 billion to tech and biotech stocks, 3x leveraged, meaning they borrowed 21.4 billion to amplify gains. By January 2000, tech made up 41% of the fund's 25 billion portfolio. Key picks: Pets.com, they bought 5% of its IPO shares at 11, Webvan, a 400 million stake, and CMGI, a tech holding company that was up 0% in 1999. Druckenmiller later admitted, "We thought we could time the top. Stupid. Bubbles don't have tops until they pop." 2. The FOMO peak March 10-14, 2000. On March 10, the Nasdaq hit 48.62 points, its all-time high. That morning, Druckenmiller got a call from a hedge fund peer. "CMGI is up 20% pre-market. You buying more?" He said yes. The fund bought an extra 800 million in tech stocks that day, within 2 hours of the peak, he later said. By March 14, the Nasdaq was still hovering at 50, but insiders were selling. Soros' team noticed. 3 top executives at Cisco, the largest tech stock, sold 250 million in shares that week. They brushed it off. 3. The crash begins March 15, April 30, 2000. March 15 was the first crack. Nasdaq dropped 124.93 points, 2.5% to 4,907. The next day, it fell another 96 points. By March 24, it was at 4,580, down 9% from the peak. Then April hit. On April 14, the Nasdaq crashed 349 points, 7.6%, its worst single day since 1987. By April 30, it was at 3,649, 28% below March's high. For Quantum Fund, disaster. The tech positions lost 5.5 billion, wiping out the fund's 2% YTD gain and pushing it to a 22% loss. The smaller quarter fund, down 32%, Soros called it a wake-up call I needed. Phase 2. The pivot. From long to short. May 1-June 30, 2000. Soros didn't panic, he reset. Here's how he flipped the script. 1. The data deep dive. May 1-10, 2000. He shut down all non-essential meetings and had his team crunch 3 months of data. Key finds: YIT.com price-to-sales ratios averaged 50 talks vs. 1.8x for S&P 500 tech stocks. What? Venture capital funding for unprofitable dot-coms dropped 31% in Q1 2000 from 12.1 B to 8.4 B. Retail investors were pulling money out. Mutual funds saw 6.2 B in outflows in April. Soros told his team, "The bubble's popping. We're going short, big." 2. Exiting longs. May 11-20, 2000. They sold all tech longs in 10 days, but not all at once. To avoid crashing prices, they used algorithms to match 15% of daily trading volume for each stock. For Pets.com, they sold 200 shares, they 15% of its average volume, until they were out, taking a 45 million loss. For Webvan, they sold 100 million worth over 5 days, losing 60 million. Total long exit losses, 1.2 billion. Painful, Soros said, but necessary. Holding on would have been suicide. 1-3. Building short positions. May 21 June 30, 2000. Now the real play began. They opened 3 types of shorts. I owe 5.2 billion in Nasdaq 100 futures, betting the index would fall. I'd 2.8 billion in individual dot-coms, Pets.com, Webvan, e-toy stocks they knew were overvalued. 1. 5 billion in tech hardware stocks, Cisco, Intel. They thought demand would drop as dot-coms folded. They used 5x leverage here too, but with a safety net. Stop losses set at 10% above entry to limit losses if the market bounced. By June 30, the Nasdaq was at 381, down 39% from March. Quantum funds short positions had made 1.8 billion, cutting the fund's loss to 14%. Phase 3. Locking in profits. The aftermath. July 2000, October 2002. Soros didn't rush. He waited for the perfect exit. Here's how it unfolded. 1. The slow exit, July-December 2000. He split the short closure into 12 batches. In July, when the Nasdaq bounced to 300, he closed 10% of shorts, locking in 200 million profit. In September, when it dropped to 859, he closed another 20%. By December 2000, the Nasdaq was at 470. He closed 60% of remaining shorts, netting another 1.1 billion. Total short profits by year-end, 3.1 billion. The fund finished 2000 down 10%, a huge turnaround from Quant's 22% loss. 2. The bubble's final collapse, 2001-2002. The pain wasn't over for the market. By October 2002, the Nasdaq hit 114.8, down 78% from its 2000 peak. Pets.com went bankrupt in November 2000. Its stock hit 0.01. Webvan folded in July 2001, losing 800 million, and eToys filed for bankruptcy in March 2001. Investors lost 5 trillion in tech stocks. Pension funds in the UK alone lost 203 billion. Soros' key lessons. Later interviews. He summed up the trade in 3 rules. Yits, don't confuse momentum with value. Just because a stock is going up doesn't mean it's worth buying. Red, cut losses fast. We sold longs even though it hurt, and that saved us. Leverage is a tool, not a weapon. We used it, but with stop losses to protect us. Why does this matter in 2024? Look at AI stocks. Some have P/S ratios of 4x, just like dot-coms in 1999. Soros' 2000 trade isn't just history, it's a warning. Manias end, and the ones who survive are the ones who don't let FOMO cloud their judgment. Insights for modern investors. First, Soros' reflexivity theory reminds investors that markets are not fully rational. Investors' perceptions and behaviors shape market trends, and vice versa. When investing in hot sectors like AI stocks, don't judge value solely based on market sentiment or stock price trends. Be alert to the gap between market expectations and actual value. Second, Soros' decisive stop-loss practice tells modern investors to bravely admit their mistakes and not hold on to losses out of pride or wishful thinking. Setting a reasonable stop-loss level is a crucial way to protect principal during investments. Finally, regarding the use of leverage, modern investors should understand that while leverage can amplify returns, it also comes with enormous risks. It must be used cautiously, and risk control measures must be in place. If you love this deep dive into the messy, human side of Soros trading, hit like and subscribe. Next episode, we're going back to 1998. Soros' failed attempt to short the Russian ruble. He thought it'd be easy until Russia defaulted on its debt, costing his fund $2 billion. It's a story of overconfidence, geopolitics, and why even the best traders can't beat a country's collapse. Subscribe now, you won't want to miss this. Thank you.